Good morning, everybody. Welcome to another Daily Market Report brought to you by Mike Bjork. Today is Hump Day. It's Wednesday, September 20th. It's not only Hump Day, but it is also Fed Day. We're at that time of the time again where every 6 weeks the Fed meets, and today they will be giving their announcement. So we'll touch on that here in just a second here. But first, let's start with the existing home sales for the month of August. So July we had 5.44 million existing home sales. Forecast was supposed to remain the same for August, and it dropped down to 5.35 million. So that's all summer long. Existing home sales continue to drop all the way through the summertime, which is obviously very unfortunate. But NAR, the real estate agents at NAR were basically stating that this is mostly due to lack of inventory. We just don't have inventory out there to sustain the higher levels we are accustomed to. So just people aren't putting their homes on listings, for sale, because they're concerned about they're not going to find another property. So we're kind of in that conundrum where people don't want to list their homes because they're concerned about where they're going to go. So anyways, to kind of move on, we'll touch on that FOMC announcement we talked about. So at about 11 o'clock Pacific Standard Time, Janet Yellen will be providing her announcement, and this is when we'll find out if they're raising rates or what they're going to be doing. So here's what we kind of expect. We expect the Fed funds rate to be continued at 1.25, no change there. We'll probably look at the dot plot map to see if there's any planned for the rest of this year. December is a possibility, but again, with everything that's been kind of going on with inflation at extremely low levels, to both hurricanes Irma and Harvey, there might be concern as to if it might be warranted to raise rates at this time. So they'll be looking for those. The big one they're really going to be looking for will be the unwinding of the balance sheet, the $4.5 trillion that they accumulated over the time of the quantitative easing from '08 to '14. Now, with that, they could be start unwinding that as soon as October, and they'll probably do it in small increments, something like around $10 billion per month. If you've been listening all week, what we've been discussing is that it doesn't mean they're gonna grab whatever they have and start selling it. No, we have a lot of these are maturity dates. They unwind with refinance and everything else. They're just gonna reduce their buying of those by approximately that much, because every month the Fed is also buying mortgage-backed securities, treasuries, and such. Anyways, so they're just gonna reduce the amount that they're buying until they reduce that amount where they want to be at. So this is kind of where it'll range. So this will take some time to unwind, because obviously $4.5 trillion is a lot of money, and obviously we don't think they want to hold that much of the debt as assets there. So prepare for that. This is kind of uncharted territory. We don't know exactly how it's going to unwind. The stock market, everybody's kind of a little concerned about it. Obviously, as there's not as much demand for mortgage-backed securities unless somebody else steps in, we don't know how that's going to affect. This could drop. This could, that could hurt interest rates, but also the stock market as well. So money has to go somewhere. So this is going to be, again, uncharted territory. It'll be kind of interesting to see how the market reacts afterwards. Expect probably a better key as tomorrow. Because today could be overblown, the reaction to it, and then tomorrow we might see a little bit more sensibility as to after they've had more time to think about the ramifications of this act, how they're going to go proceed and what the attitude would be. So tomorrow will probably be a better indicator. But if you guys got interest rates, or if you got stuff out there floating, might want to kind of lock in just ahead of time, or at least float and see how the market reacts. If it starts looking negative, then you might want to lock in. All right, so let's kind of jump ahead forward here. Basically, the stock market's mixed. Just ahead of it, the Dow is the only one up, whereas Nasdaq and S&P were down. These every time they go on gains, they open up. Pretty much, they're starting off in new uncharted territory as they're reaching highs. All three levels have been pretty much at highs, and they've been going up quite a bit. Going up throughout the past week or so and reaching new highs every single day. Obviously, that's becoming kind of old news. So again, this could all change. This is so far ahead of the FOMC, so this could obviously change as to depending on what the Fed says after their announcement at 11 o'clock Pacific Standard Time, which is basically only a couple hours from now. So let's see how the bond market's looking now. We are currently up about 3 basis points from where we left off yesterday. So here's where we left off yesterday. We touched the 50-day moving average. Today we really tried pushing the 50-day moving average on a low. Right now we're up from where we left off. So here's our low, and here's where we are now, up about 3 basis points so far. So we're in kind of a positive territory. But again, we got to be a little cautious as to what the Fed, how it's going to react to the Fed later on today. So this could quickly change. But the nice thing is that we've been kind of in this channel here between the 25 and the 50-day moving average here. So we've been kind of in the sideways pattern. So we haven't had huge fluctuations or much of a fluctuations in interest rates for just over a week now as a result of it. So let's go ahead and take a look here at the 10-year Treasury. Same thing. Now this is in this very narrow since we went over the last couple of days this week. This very narrow channel here. We got the 50-day moving average, and now we got the 100-day moving average because we broke above that on Monday, and now we're kind of in this range. So we're down about 1 basis point for Treasury. So we closed yesterday about 2.24%. Now we're down to about 2.23. And remember, at one point, just about 2 weeks ago, we were down all the way down to about 2.01, and now we've jumped up quite a bit. We jumped up almost a quarter of a point, just 25 basis points, just to go up quite a bit. So that's how much of a fluctuation in rates we've seen here in the 10-year Treasury. All right, so again, we want to try hold these. Hold this 25-day or this 100-day moving average. We want that to hold, and we want the 50-day moving average on the. Go back here on the 50-day moving average. If anything, we want to see a break above the 25-day here so we can get some more positive pricing here. All right, so that pretty much wraps it up. I hope you guys have a wonderful day, but if you guys want to get more updates, especially information on the FOMC, come over to Twitter. You can find me at Mike Bjork, and we'll get you updated as soon as possible. You guys have a wonderful day. Thanks so much for watching. We'll see you guys tomorrow. Bye-bye.